Investors are continually looking for the top undervalued stocks to buy. And in this video, we're going to look at the top 3 stocks that are being analyzed and talked about inside Joel Greenblatt's highly touted and exclusive Value Investors Club. Stock number 1, TSM, Taiwan Semi Conductor. Let's pull it up right here. Now, Taiwan Semiconductor is getting a lot of news lately. It's the world's largest foundry, and I'll get into that in just 2 seconds. But first, let's just look at some high-level things. First off, it's currently at $192 per share. All-time high was just a few weeks ago at $212. The 52-week low was 90, and that's only in the last 52 weeks. So look at how much volatility in this stock price. Last 5 years, it's up 300%. Last year, 111%. Year-to-date, 92%. So, of course, naturally, a lot of people are going to be very interested in this company, and it gets a lot of attention. But remember, a stock at all-time highs isn't necessarily a bad deal. It could be on its way to higher highs because the fundamentals are getting better. This is a company with $1 trillion market cap and $1 trillion enterprise value. That means there's essentially zero debt in the company. Okay. Some other things that I look at here that I don't really like: big difference between the free cash flow and the net income. 1 year free cash flow of $22.3 billion compared to $33 billion in net income, and the 5-year free cash flow $11.8 billion versus $24 billion in net income. Now, it could be easily explained away. This could be because of massive investments that they're making, which will drag down their free cash flow. But in the long run, net income and free cash flow, they should equal out. And a lot of investors, especially value investors, will ignore a company where the discrepancy between free cash flow and net income is so big. Another thing I find very interesting, this 1% dividend yield eats up about $10 billion of their free cash flow. Guys, I look at this going, that's a big chunk of their free cash flow here. That is not small. And I look at it also saying, this company probably has a lot of growth potential. Why are they paying out such a big dividend here of $10 billion? I have no idea. Great profit margins here. 5-year profit margin of 40, last year's profit margin at 40%. Another thing to look at, guys, the growth rate. This company is growing a lot as of late. Why? Because the chip industry in general has a lot of growth in it. So just like NVIDIA, this thing is growing like crazy along with net income and free cash flow. Their net income alone went from $8 billion to last year at $26.72 billion in the last 10 years. Now, the question I have is, have they been doing it naturally or through acquisitions? So how do you figure that out? You go to the cash flow statement. In the cash flow statement, there's specifically a line for acquisitions and dispositions. No, I mean, this is nothing. $128,000 net, $17 million in their pocket. So I look at this saying, okay, this company has done it largely through internal growth. That's an incredible feat, which I love. Now, here's the 8 pillars of Taiwan Semiconductor. Guys, look at this. It's like a lot of the companies we see. Now, again, the one thing I don't like is the PE, 5-year PE, is much lower than the 5-year price of free cash flow. Now, you might sit there and say, Paul, that's a good thing. If the ratio is higher, it means the amount is less. So they're reporting a lot lower free cash flow, like we said here before, versus their net income. High return on invested capital, shares about the same. $42 billion in revenue growth. Now, one thing I do like is net income has grown $17.5 billion off of that, and cash flow has grown $18.5 billion. So there might be a very, very valid reason why their 5-year free cash flow and 1-year free cash flow is so much less, because I see the revenue growth led to a bigger free cash flow growth than net income growth. That's very, very important here. I like this a lot, okay? And of course, very little debt. Now, this 8 pillars is supposed to tell a story. So what's the story on Taiwan Semiconductor? It's the things to look at here. Why is the free cash flow growth so much higher and better than their 5-year average free cash flow? You need to understand that reason. Now, in terms of the story behind Taiwan Semiconductor, this is the world's largest foundry with 70% market share. And in the most advanced kind of chips, they have a near monopoly of almost 90% share. The only other companies that are able to manufacture these kinds of nodes are Intel and Samsung. Now, TSM is making chips for companies like NVIDIA and AMD that have no capability to manufacture their own chips. And the other segment is known as IDM, or Integrate Device Manufacturers, similar to Intel. Now, TSM is in a winner-take-all kind of business. It's really hard for Samsung or Intel to break through, which allows TSM to gain market share and reinvest heavily in new R&D, further widening this exact moat. Now, as you know, Intel is building their own foundries, but a lot of companies have expressed a concern about buying into Intel's foundry out of fears of they're competing. They're having the same competitor make their own chips. That's kind of a problem for them. So these are the things that give TSM kind of a leg up to the competitors. So how much growth does TSM have according to analysts? Well, very simply, I'm actually surprised. $134 to $2. That's about a 50% growth in the next 4 years. Still ample, still 10, 12% a year. And in terms of revenue, looks a little choppy here. Look at this graph, 90 billion to 130 billion. Substantial overall percentage growth, but in terms of why is there this drop, I have no idea. It could be due to a low number of analysts here, only 3 analysts. So of course, guys, any sort of time you have an investment, the question is, what's it worth to you today? And for those of you who are in our community and have our software, this is why you guys use the stock analyzer tool so much. For those of you who don't have it, I want you to understand that every investment is the present value of all future cash flows. So whatever you pay today, your returns will be based on all the cash flows the company receives in the future. Because even though you buy a stock and you don't get all the cash flow from it, the balance sheet gets better by either increasing cash or paying down debt, or they're going to use that cash to grow the business. You're getting the growth in some way. But since we don't know the future, we have no idea of knowing what the right price to pay is. That's why the stock analyzer tool is so useful. You can put in your low, middle, and high assumptions on revenue growth, profit margin, your multiples at the end, PE, and your desired return. It'll tell you, based on those assumptions, what is the right price to pay. So let's go take a look at the last time I did TSM. Back in July. Oh, look, I got points. Now, guys, I did a 10-year analysis, and the hard part is we don't really know. There's a wide range of what the growth rate could be in this company. So I did 1, 7, and 13% revenue growth. You might sit there and say, well, Paul, look at the last 10 years. They've grown significantly and their growth has gotten faster. Yes. But the question is that going to continue? Maybe I'm being too conservative. That's all the more reason why you need to use this tool yourself. Profit margin. I did 35, 38, and 41. Free cash flow, I did 17.5, 20, and 22.5. Probably on the light side, but I'm still going to keep it there anyhow. Now for PE and price of free cash flow, it's what is this going to be in 10 years? Not today, in 10 years. I put in 16, 18, and 20. Mostly because it has a higher ROIC and it has that competitive advantage that we saw in the story about Taiwan Semiconductor. So I'm okay doing 16, 18, and 20. And finally, for pretty much all companies, I put 9% return in. Now, guys, this has no margin of safety in there, but you need margin of safety. How do you give yourself margin of safety in the stock analyzer tool? You make your desired return higher, because the more you return, the lower your price. And remember, 9 or 10% is just the market return. And if you just want to get the market return, no reason to buy a stock. So I hit the analyze button. The stock's currently at 192. We have a low price of, let's focus on the earnings, 77, high price of 260, middle price of 140. So in the last year, it was as low as $90, which was pretty close to our even low number. So I think this is just a matter of being patient. But again, if you have other insights, I was probably more conservative on the revenue than I should have been. So obviously, by all means, go in a stock analyzer tool and do it yourself. Stock number 2, Marvell Technology, currently selling at $85 a share. Its all-time high was December 8th of 2021 at $94. Now, again, good balance sheet, $73 billion market cap, $78 billion enterprise value. Very, very good balance sheet, especially considering their 5-year average free cash flow is $800 million. 1 year is 1.4. Now look at this. How different is this than Taiwan Semiconductor? Look at the difference here. They're showing net income losses over the last 1 year and last 5 years, but they're showing cash flow, plenty of cash flow in that time. Pretty interesting there, okay? So I'm going to focus on the free cash flow of this business. And look at this volatility, guys. All-time high, $93.85. hit a low in the last 1 year alone of $50.35, almost a 50% drop on this company. So let's go look at the 8 pillars here. Oof, this is ugly. Real ugly. Ugly as F. This is what I don't like. This is the one I don't like the most. Why are their shares up 30% in the last 5 years? Did they make an acquisition? Let's go check out their income statement where the shares outstanding will be at the bottom. And we look at the shares outstanding and we see some big jumps here. 668 to 7, it's 800 million to 850. So there might have been an acquisition here. How do we verify that? Well, it was between 21 and 22. Let's go to the cash flow statement and look at their acquisitions. Yeah, acquisition right here, 3.56 billion. My guess is they're sitting there making acquisitions with shares. That could be fine if the stock is massively overpriced. But at the end of the day, you have to remember, if you're a shareholder, that when you get diluted, you own less and less of the business, even though the number of shares you have stays the same. If there's a company with 10 shares outstanding and you own one, you own 10% of that business. If they increase the number of shares to 15, you now own one share still, but out of 15 shares, you now take your ownership from 10% down to 6.66%. You've been diluted 33%. And that's something important to remember if the company is obsessed with diluting their owners. So what's the story on Marvell? Well, guys, they're a direct beneficiary of AI, where 70% of the company's business comes from semiconductors made for data centers. And as you guys have heard a lot, data centers are the talk of everything. They make custom chips for large companies like Amazon, Microsoft, and Google. I don't know if you've ever heard of those people. In addition, they have 70% market share in a special kind of chip that moves data around within the data center. It's called a digital signal processor. Now, their revenue breakdown by market is as follows: 40% to data centers, 22% with enterprise networking, 19% on carrier infrastructure, 11% to consumers, and 8% to automotive industrial companies. Now, here's where the big growth comes from for this company. All the big major tech companies, those as the hyperscalers, they want to develop their own custom chips. They want to do it for AI and non-AI uses. And they have to partner with one or two companies, Marvell or Broadcom. That's it. Now, it's a super complex problem, and it's expensive to do this. But Marvell is the one that has the infrastructure already in place to do that. Now, as I said earlier, they've already done work with Amazon. They've already done work with Microsoft, and they're doing work with Google. But it's basically just a fight between the two companies, Broadcom and Marvell, to earn all the large tech businesses and make their chip. So what are the analysts saying about Broadcom? Well, let's pull it up right here. Oh boy. So a drop in their EPS, but look at this growth, $1.54 to $6.45 in the next 5 years, according to the analysts. But look, analysts are going from 33 down to 3. So it could be skewed, and remember what I feel about analysts. Let's go look at revenue growth. 5.6 billion going to 13.54 billion according to analysts. That is some pretty impressive growth. And of course, guys, you have to know, when you have a company with good margins, a lot of growth potential, and potentially in its own moat, you have to pay a premium for that. Now, guys, we just analyzed these two stocks. And remember, this is only a sample of the stocks we've analyzed. In the last month alone, on our YouTube channel, we have analyzed 48 companies. And that doesn't include the exclusive content we make inside the community. And even better, our community members have analyzed 1,611 stocks using our stock analyzer tool that I talked about earlier. This one right here. And we keep track of this data because we want to make sure that we see our users using it. And it's great when we see increases. Now, the best thing about the people in our community is they aren't scared when they see stocks they own fall or when the entire market's having a red day. In fact, they're excited. We sit there and we talk. I see the comments. Great day, red day. Great time to buy. And as you guys know, it's more important than ever. You have to surround yourself with people who are calm and excited to buy stocks as they get cheaper. Most of the people in your life will be scared and make emotionally charged investing mistakes when stocks fall, not us. We get excited, we get enthused, and we sit there and say, it's something we love, selling it for a cheaper price. You can't afford to stop investing. And what's most important is you have to understand what you're buying when you buy a stock. So join a community of like-minded investors that are going to help you understand the stocks you want to buy, share ideas and research, and also support you when stocks are falling. Everybody makes emotional mistakes when stocks are falling. Everybody makes emotional mistakes when stocks are flying up. You can't do this alone. So it's time to surround yourself with people who are headed in the direction that you want to go. So if you're new to EM, when you go to everythingmoney.com, you'll see that we limit the number of daily spots to our community and software. And the reason for that is that we're solely interested in having like-minded investors who can help each other with the data, the analysis, but most importantly, and this is the absolute most important part to successful investing, is to be able to handle the emotional part of investing. They always ask Warren Buffett since 1970, how do you become a successful investor? It's all about the emotional fortitude to be able to do so. But how do you get there? Well, successful investing and a successful life is about surrounding yourself with like-minded people who are where you want to be. And our community has thousands of those members who are exactly like that. Now, guys, we are working behind the scenes to make the software better every single day. When we launch these changes, the current offer of everything that we have, all of these tools, is going to go away. But if you sign up today, not only you get all the software, all the data, and all the tools we've made so far, but you're also going to be locked into your pricing tier forever. You get everything right now in one great and easy deal. So you're interested in having all the tools to analyze stocks and a supportive community that'll help you sleep better at night and make more money, go to everythingmoney.com/signup or click on the link in the description below and sign up before the changes occur. And I guarantee it'll be one of the best investing decisions you ever make. So guys, what's the right price to pay for Marvell Technology? Well, guys, here's our 10-year analysis on Marvell. And there's a lot of information here that's kind of a lot of guessing. I did 4, 7, and 10% revenue growth. That's basically doubling every 10 years in my middle assumption. Now for profit margin, as you guys can see, negative. So I'm basically going to ignore this. I just put 4.5, 5.5, 6.5. It's probably all baloney. Free cash flow. Look at this free cash flow growing over the last 10 years from 14.5%, 17.5%, and 26% in the last year. I don't know if this 26% is sustainable for long periods of time. There's a lot of demand for chips right now. What if that demand wanes? What if more competitors come in? There's a lot of questions to be answered here. So I put 13, 17, and 21%. Now for my PE and price of free cash flow, I did 13, 16, and 19 because even though there's a lot of growth potential here, ROIC is low, so I'm just being a little more conservative, and I did my 9% return. I hit the analyze button, $85 stock right now. I'm going to focus on cash flows. I have a low price of 12, high price of 40. Guys, for me, I just look at this saying, it's not in my wheelhouse. I don't understand this. And the other thing is they're diluting investors like crazy, so I don't even know how many shares are going to be outstanding in the next 5 or 10 years. If you have a better understanding of it, please go do it because I currently don't. And I'd love for you to engage in the community about that. Stock number 3 in the Value Investors Club is Disney stock. This is a stock I own. Remember, don't ever buy something just because I or anybody else on the internet or even Warren Buffett owns it. We're here to teach a process of understanding what you're buying and why. If you apply that process to the things you understand, you'll probably do quite well. I own Disney for one reason and one reason only. Well, not one reason only. It's the mode of all modes, I would guess. But look at this profit margin. 5.3% last year, 2.6% in the last 5 years. But yet before COVID, their profit margin was 10 to 15%. And look at their revenue. All-time record highs. We're at 90 billion in the last 12 months. And before COVID, the peak was 70 billion. So I'm looking at this thinking, okay, this is pretty incredible. And their profit margin has been quite suppressed. Since Disney stock has underperformed for a decade, investors are just getting completely sick of it. They've sort of started to move on. I hear the negativity, even our community, about Disney. And a lot of the recent margin problems they've had can be attributed to that massive shift from Disney Media as a TV company to a direct-to-consumer model. Guys, this kind of shift is huge and can take a really long time, maybe even 5 or 10 years to work itself out, as it's a major disruption to an underlying industry that's been the same for decades. At Disney's current price of $95 a share, based on our analysis, you're basically only paying for the parks business, and the rest of the company is free. Parks did roughly $9 billion in pre-tax earnings, which is expected to grow to $12 billion by 2027. So after tax, let's assume $7 billion. If you apply a multiple of 20 times that, you're at $140 billion. And I would argue maybe even a bigger premium because of the moat. So you're seeing at $180 billion market cap, and 140 to 180 of that can be attributed just to parks. So the rest of the stuff in the company might just be free. Now, obviously, it's not necessarily free. They have to start generating more and more profit from it, but there's a lot of profit potential based on the assets that Disney currently owns. Also, one of the benefits is the direct-to-consumer model seems to be making some progress right now after years of increased spending and losses in order to compete with companies like Netflix. It was break even for the first time, and the earnings potential for this branch of the company is very high. And Disney's content is super high quality and family love it. Now, obviously, I watch Hulu. I watch ESPN, which is part of the Disney family, but my brother and his daughters all watch Disney Plus. Our analyst Dalton, he watches Disney Plus nightly. So I think there's a lot of potential there for upside for such a large company. So let's see what the analysts are saying about this company right now. $5 per share, going to $7.73 in the next 4 years. So double-digit growth every year. Nothing to write home about, but nothing bad. Revenue growth, $92 billion this year to $112. 3 to 5% a year. And that's about what you're going to get from a company like Disney. How do they really, really move that needle much faster? So, of course, it goes back to what's the right price to pay for Disney stock? And the last time I did this analysis was on May 7th. And here is my 10-year analysis that I did. I did 3, 5, and 7% revenue growth. I can understand if somebody said, Paul, it should be 2, 4, and 6, whatever you find beneficial. But here's one thing. This ROIC has been beaten down by the last 4 or 5 years. So I'm not worried about this ROIC being lower. Profit margin, I did 9, 12, and 15%. Look at this. With the margin beat up over the last 4 or 5 years, they're still at 8 and 9% on profit margin and free cash flow margin. So this is a company that can easily do 12%. And of course, PE and price of free cash flow. I actually wonder if 18, 21, and 24 is too low. It's freaking Disney. If I gave you $200 billion right now to compete with Disney on all the businesses they have, the parks, the Disney Plus, all the content they have, how would you do it? It'd be very difficult. I don't think you could. So maybe this premium should be higher. I'm just putting 18, 21, and 24 in here just to be a little conservative and a 9% return. Hit the analyze button. I got a low price of 75, high price of 210, middle price of 130. And if you pay today's price based on my middle assumptions, it's a 13% return, including dividends. That seems to be a pretty decent opportunity out there for me. But of course, do your own research. Now, guys, if you want to find a top stock to buy right now, watch our next video. Thank you for your time.